Welcome back to another deep dive. We are so glad you could join us today because, honestly, we have a massive stack of economic reports, central bank speeches, and market data from mid-July 2026 to get through.
Yeah, it's quite the pile this time around.
Right, and our mission today is to decode what feels like a massive global economic paradox. I mean, we have cooling headline inflation, but at the same time, we've got central bankers actually calling for rate hikes.
Exactly, which makes no sense on the surface.
Right. And then you look at the stock market, which is generally booming, but we're seeing these sudden, violent sell-offs in the biggest tech names out there. And on top of all that, we have the promise of this totally frictionless AI economy just, colliding with massive physical supply chain bottlenecks.
A lot of conflicting signals for sure.
It really is, but I promise you, by the end of this deep dive, you will understand how the price of a computer chip, a Ukrainian wheat shipment, and the Dallas Fed's interest rate policy are all intimately connected.
And that's really the core of what we do here. Because, I mean, in a world of absolute information overload, making sense of these contradictory signals is the key to understanding where the global economy is actually heading.
Yeah, exactly. So let's start with the macro picture. Because to understand the global economy, you have to look at the scoreboard, right? And right now, the scoreboard is just flashing these totally conflicting numbers.
Flashing red and green at the same time, basically.
Totally. So looking at the Edward Jones report, we got some seemingly good news. June CPI, so Consumer Price Index, the headline inflation, actually slowed down to 3.5% year over year. And expectations were like 3.9%, so that's a beat.
A significant beat, yeah?
Right, and core CPI cooled down to 2.6%. Plus, the Producer Price Index, the PPI, that slowed to 5.5%. So naturally, the markets are reacting really positively to this. They're expecting the Fed to just be patient, hold rates steady.
Which is the logical reaction if you just read the headlines.
Exactly. But then we have the contrarian view. And I want to bring in Dallas Fed President Lorie Logan's recent speech in Houston. Before we get into her stance, though, we need to make it super clear to you listening that we are impartially reporting the data and the Fed president's viewpoints here. We are not endorsing any specific political or economic policy. We're just looking at the math.
Right, absolutely. We're just analyzing the mechanics of what they're saying. And what Lorie Logan is saying is actually really fascinating. Despite that big drop in CPI, she is actively advocating for modestly higher interest rates.
Wait, really? But the numbers just dropped. Why would you want to hike rates now?
Well, because she attributes that CPI drop to a totally temporary dip in energy and housing. It's noise, basically. You have to look at the different thermometers they use to measure the economy.
Okay, let's unpack this. What other thermometers are we talking about here?
So she's looking at PCE, personal consumption expenditures. Right now, headline PCE is at 4.1%.
Okay, that's higher than the CPI.
Yeah, and core PCE is at 3.4%. But the really concerning metric is the New York Fed's multivariate core trend model.
That's a mouthful.
It is, yeah. But basically, it's a sophisticated model that strips out all the weird sector noise. And that model has been hovering right around 3.4% for 3 years now.
Wow, 3 years, so it's just stuck there.
Exactly. It's incredibly sticky. But then you have this other metric, the trimmed mean PCE, which is currently sitting at like 2.4%.
Okay, so 2.4% sounds great, right? That's super close to the Fed's 2% target.
It sounds great until you look under the hood. Logan brought up some staff research showing that this 2.4% figure might be artificially low.
How so? Like, is the math wrong?
Not wrong, but the algorithm is behaving strangely because the economy is strange right now. The trimmed mean is designed to drop extreme price changes on both ends, right? The massive spikes and the massive drops.
Right, to find the true average in the middle.
Exactly. But the research shows it's currently dropping way too many valid price increases because there's this massive right tail of service inflation. It's essentially filtering out the actual inflation, thinking it's just an anomaly.
Okay, so it sounds like we are reading a thermometer in the living room that says 70 degrees, but Logan is pointing out the kitchen is literally on fire.
That is a perfect analogy, yeah. The algorithms are blinding us to the heat in the kitchen.
Okay, but let me push back a little. If inflation is supposedly cooling, according to the headlines, why did Logan note that CEOs in Texas are actively raising workers' pay just to manage the cost of living?
That's the wage productivity gap. And this is just mathematical reality. We have unemployment at a super low 4.3% right now.
Right, and we're adding what, like 92,000 jobs a month?
Exactly. The labor market is incredibly tight, so workers have leverage. And when inflation outpaces productivity-adjusted wage growth, that gap has to resolve in one of three ways.
Okay, what are the three ways?
Number one, inflation simply comes down on its own. Number two, wages go up to meet inflation. Or number three, the worker's share of income just falls, meaning people get poorer.
And obviously nobody wants option 3.
Right. So what happens is wages go up. But the danger there is that businesses then raise prices to cover those higher wages, which triggers this persistent inflationary loop.
A wage price spiral.
Exactly.
Yeah.
And that's exactly why Logan is worried. She sees the wages going up in Texas and knows it's going to bleed into sticky service inflation.
Wow. Okay, so we've established that inflation is sticky and the headlines are kind of lying to us. But why is it so sticky? Logan actually cited a highly unexpected source of physical inflation in her speech, which was artificial intelligence.
Yeah, that was a huge moment.
And I feel like this transitions us perfectly into the wild movements happening in the stock market right now, because AI is supposed to be this magical deflationary software, right?
That was the narrative for the last few years, yeah. But what we're seeing now is the AI CapEx boom, capital expenditures. AI is no longer just a software phenomenon.
Right. It's not just ChatGPT writing emails anymore.
Exactly. The massive investment demand for AI is expanding price pressures way beyond just computer chips. It's bleeding into massive physical sectors. We're talking power generation, the electrical grid, heavy construction, cement, copper.
Because you actually have to build the data centers.
Yes, and they are massive. They require insane amounts of electricity and cooling. So this digital boom is creating a massive physical supply shock.
Which brings us to the market reality check. Let's look at the data from BNN Bloomberg and Edward Jones. Despite S&P 500 technology earnings expected to grow an insane 61% year over year.
Which is a staggering number.
It's massive. But despite that, the tech sector is seeing this incredibly violent rotation. People are selling off.
Yeah, the market is getting very nervous.
Very. I mean, look at these drops. The NASDAQ was down nearly 400 points. South Korea's KOSPI index plummeted nearly 9% overnight. And that was entirely due to semiconductor weakness.
Right. South Korea is heavily weighted toward memory chips, so they feel it first.
Exactly. And looking at specific stocks, the whiplash is crazy. Micron Technology fell 5.6%. I mean, they're still up 199% for the year, but still. SanDisk fell 12.6%, though they're up 494% on the year. Western Digital sank 9.2%. Even NVIDIA fell 2.4%.
It's a violent repricing of risk.
But wait, if AI is supposed to make our economy infinitely more efficient and, deflationary, why is the sheer act of building it causing physical bottlenecks and making the stock market just totally panic about valuations?
That's the billion-dollar question. What we're seeing is tension between AI's future promise and its current physical cost.
Yeah.
The market is facing what we call a growth scare.
A growth scare.
Yeah. Investors are suddenly questioning whether this voracious demand for memory and processors is actually sustainable.
Oh, I see. Like, who is actually buying all this compute power?
Right. And more importantly, will the companies buying these chips actually generate enough return on investment to justify these astronomical valuations?
Yeah.
Or the massive infrastructure spending? If you spend $50 billion on data centers, you need to sell a lot of software subscriptions to make that back.
Right. And if the software isn't making enough money yet, the CapEx has to slow down eventually.
Exactly. And that's why the chip stocks are getting hammered despite being up so much on the year.
Okay, to truly understand how this tension between AI efficiency and these physical supply chain bottlenecks actually plays out on the ground, I want to zoom in on a single corporate giant. Let's look at GE Aerospace's Q2 2026 reality.
They are the perfect microcosm for this entire macroeconomic situation.
They really are. Let me just share these blockbuster numbers from their Q2 earnings. Orders are up 17%, revenue is up 24%, earnings per share up 22%, and their free cash flow was up an astonishing 43%.
Those are just massive margins for an industrial company.
Insane margins. And their commercial services backlog alone is a staggering $170 billion, plus a defense backlog of over $30 billion.
So demand is basically infinite for them right now.
Right. But there is a huge physical bottleneck. You pointed out a pretty dark spot in the earnings call, specifically from their CFO, Rahul Ghai.
Yeah, he had a warning that kind of got buried under all the good news. He noted that spare parts delinquencies increased 20% sequentially.
20%? That means they're just late delivering parts to their customers.
Exactly. What this means is GE has off-the-charts demand, literally billions in backlog, but they are physically constrained by material availability. They simply cannot get the raw parts fast enough to build the engines.
And this is where the AI solution versus the physical limit comes in, right? Because they highlighted this new operating model called Flight Seat Dick.
Yeah, Flight Seat Dick is fascinating.
It is. There was this amazing data point where GE used AI to automate the demand signals across these specific parts called turbine airfoils. And by using AI, they cut the processing time by nearly 90% across 190 different parts.
Which is a miraculous achievement in software efficiency.
Right. But here's where it gets really interesting. GE is using AI to process orders at actual lightning speed, but the physical parts are delayed. It's like upgrading your brain to a supercomputer, but your physical hands are just moving in slow motion.
That's exactly it. The software is in 2026, but the metallurgy and the forging processes are still bound by the physical laws of the universe. You can't 3D print a high-stress turbine blade in 5 minutes. It takes weeks of casting, cooling, and testing.
Yeah, the physics just don't care how fast your AI is.
Exactly. But to balance this out, we have to note GE's physical engineering triumphs, because they aren't just sitting still.
Right, they are fighting back on the physical side, too.
They really are. They managed a 60% reduction in production lead time for an F-110 component up in Lynn, Massachusetts.
60% is huge for heavy manufacturing.
It's massive. And they also introduced the LEP-1B durability kit. This is a huge deal because it promises a twofold improvement in time on wing.
Meaning the engine stays on the airplane twice as long before it needs to come off for maintenance.
Exactly. Which effectively cuts the need for spare parts in half for those engines over time, and their turnaround times for maintenance drop to 100 days.
That's incredible efficiency. And briefly, I do want to mention that CEO Larry Culp explicitly acknowledged the Ryanair Flight 1879 investigation during the call. I think that just shows that amidst all this rapid growth and pressure to deliver, GE is keeping a strict focus on safety.
Absolutely crucial in aerospace. You can't move fast and break things when you're building jet engines.
No, definitely not. But so GE can't get their parts right, and Lorie Logan is worried about inflation spiking again. Why is this all happening at once? Well, it's because the physical roads of the global economy are quite literally under fire right now.
Yeah, the geopolitical choke points are taking a massive toll on the physical world.
Exactly. So we're moving from the corporate boardroom to the global stage. And before we get into the specifics, I need to explicitly state again for you listening that we do not take any sides in the U.S.-Iran or Russia-Ukraine conflicts. We're strictly reporting the events as detailed in the StoneX and Edward Jones material to analyze their economic impact on global supply chains.
Right, our focus is purely on the economic shockwaves these events cause.
Exactly. So let's look at the Middle East and the Strait of Hormuz. The situation is escalating fast. The U.S. has carried out military strikes against targets in Iran and reinstated a blockade on Iranian shipping.
Which is a major escalation in the region.
Huge. This includes a strike on a supertanker near Karg Island. And for context, Karg Island is where 90% of Iranian oil exports flow through.
90% is basically their entire export economy bottlenecked in one spot.
Right. And Iran has retaliated against U.S. facilities, but more importantly for the supply chain, they are urging the Houthis to strike ships at the Bab el-Mandeb Strait.
And that is the real economic choke point.
Right, because their goal is to shut off Saudi oil exports heading to Asia. And the economic impact is immediate. WTI crude consolidated near $80 a barrel, and Brent crude is near $86, though it's been fluctuating.
Yeah, because suddenly the insurance premiums for these massive oil tankers skyrocket, or they refuse to sail through the Red Sea at all.
And at the same time, we have the Black Sea and the global food supply under threat.
This is the second major conflict zone disrupting supply chains.
Yeah, Ukraine is striking Russian ships near Novorossiysk in the Black Sea, which effectively cuts off Russian exports through the Sea of Azov. And in return, Russia has essentially shut down waterborne Ukrainian grain exports completely.
Which is a devastating blow to global agriculture. We have to remember the stakes here. Ukraine is the fourth largest exporter of corn in the world.
Wow, fourth largest. I didn't realize it was that high.
Yeah, they are a massive breadbasket. This threatens global supplies of wheat, corn, and essential edible oils.
Okay, so I have a question about this. We're looking at two totally different regions, the Middle East and Eastern Europe. But they're both fundamentally wars over commodities, right? Oil and grain.
Pretty much, yeah.
So how does the global just-in-time supply chain survive when the physical oceans are essentially closed for business?
Well, the short answer is it barely survives, and it becomes incredibly expensive.
Because they have to take the long way around.
Exactly. This is the macro picture synthesizing all these pieces. This is the ultimate threat to price stability. Remember earlier when Logan warned about refining capacity constraints keeping fuel prices high? regardless of crude supply.
Right, because even if you have the oil, you can't refine it fast enough.
Exactly. And now if these massive tankers have to avoid the Suez Canal and take the long route all the way around the Horn of Africa,
That adds, what, weeks to the journey?
weeks of travel, massive increases in fuel consumption just for the ship itself, and huge jumps in labor costs. The cost of everything from energy to food goes up exponentially.
Which feeds right back into the inflation problem.
Exactly.
Yeah.
It makes the Fed's job of fighting inflation incredibly difficult. You can raise interest rates all you want, but a higher interest rate doesn't make it safe to sail a grain ship through the Black Sea.
Wow, yeah, it really doesn't. And that brings it all together perfectly. We journeyed from the Dallas Fed's warnings on sticky inflation to the stock market's anxiety over AI infrastructure costs, to GE Aerospace having brilliant software but physically constrained operations.
And finally, to the geopolitical conflicts choking the world's commodity supply lines. It's all one big interconnected web.
It really is. And for you listening, whether you are managing a portfolio, running a business, or literally just buying groceries, these converging forces dictate the cost of living and the cost of doing business in 2026.
It's unavoidable.
Yeah.
You have to pay attention to the physical realities, not just the digital promises.
Absolutely. And I want to leave you with a final thought to mull over. We constantly hear that the future economy belongs to the realm of the digital, right? Algorithms, data, artificial intelligence. But looking at these supply chain crunches and the geopolitical wars over shipping lanes today, what if the true victors of the AI revolution won't be the ones with the smartest code? What if it's the ones who secure the most raw, unglamorous physical commodities required to actually build it?
That is the million-dollar question for the next decade.
It really is. Thank you so much for joining us on this deep dive. We'll catch you next time.